Views expressed by Camaplan podcast guests may not reflect those of Camaplan. Camaplan does not guarantee the accuracy of information provided by guests, nor does it endorse or recommend any individual or organization. Camaplan is not an investment advisor, CPA, realtor, or attorney. You are encouraged to conduct your own due diligence before making investment choices. For any tax, legal, accounting, investment, or other questions, please consult a specialist. Hi, I'm Michael Duncan, and welcome back to The Road to Financial Freedom. This podcast is brought to you by Camaplan, a self-directed IRA administrator focused on educating investors on how to grow retirement savings faster through alternative investments. In each episode, we're going to take an in-depth look at the many roads taken to financial freedom and how they differ for each of our guests. Our goal is to help the listeners learn how they can achieve their own financial freedom through the experience and stories of experts that have done just that. Today's guest is the Managing Director of Common Ground Capital Fund II, LLC, where he brings over 19 years of architectural, construction, and development experience to the organization. He's best known for creating award-winning design, minimizing costs, and maximizing operational efficiencies within real estate. I'm very excited to welcome Ty Lee to the show. Ty, how you doing today?
Great. Hey, Michael, thanks for having us.
Of course. Thanks for coming on. We met through a mutual connection of ours, someone who works here at Camaplan, and she had nothing but great things to say about you guys and all the stuff you're doing. So I'm really excited to kind of dive into what you guys are doing there, and also your journey and how you got to where you are. So if you'd like, I would love to start by just asking, where did this all start for you? I said it in the intro, you brought over 19 years of all this different architectural and construction stuff. How did you get to where you are today?
Yeah, glad to share that. So I think for me, I've always wanted to make things. And I remember, and I'll try to keep this as brief as possible. I remember getting Lego sets when I was a kid from my parents, and I would take a look at the instructions I got, and I said, wow, this is so boring. I'm not building this. And I would just build my own thing. And I think ultimately that may have been foreshadowing to an architectural degree at the University of Tennessee. So I can empathize with your SEC visit there for South Carolina. And so I worked for global architecture firms. We did projects all over the world, giant projects, and really love and have a passion for design. So I got an opportunity to go to CBRE after practicing architecture for about a decade. And I had to go do it because I had to see what it was like within the world's largest real estate company. And that's when I really got a chance to understand large commercial leases and deals and transactions. And was fortunate enough after that, one of our clients was a developer in Dallas. And he said, why don't you come join me and let's go do acquisitions and development together. And we did. So then for the next 8 years, I was working on mixed use commercial acquisitions and development. Think like office space, multifamily, and retail all around like a green space. And that was great. An incredible experience, learned so much about the financial world of real estate. The problem was that the biggest rentable space in any of our projects was office.
Mm-hmm.
Even before the pandemic, I was a little nervous about long-term leases going away with the rise of co-working and spec suites and some other things that were happening. I felt like leases were going to start to shorten to 3 to 5 years, maybe 7 years max instead of the normal 10. And the problem with that is the capital markets buy and sell office buildings based on future NOI. So they love long-term leases. And so when the pandemic hit, it was kind of the final nail for me. And I said, well, I need to find a different asset class. I love real estate. It's in my blood. I'm going to do real estate, but what asset class do I want to do? And I did a lot of research, love industrials, back of the house for the internet, multifamilies based on population growth. It's going to do fine ultimately. But single family was really interesting, Michael, in that there was this massive supply demand imbalance because after the '08 crash, all the home builders stopped building homes. Meanwhile, millennials were which is now like the largest generation group in our country. They're having families, they need homes, they need schools. An 800 square foot apartment does not cut it. And so this wave of demand came right at the perfect time of really low supply. And so I also felt like single family is just really antiquated, Michael. Not a whole lot of innovation in that space. The way
Yeah.
communities are designed or amenitized, and the homes themselves, how they're designed, technology integration. So today, Fund One owns 45 homes and $20 million value. And we just launched Fund Two to buy a few hundred more homes and also do brand new build for rent communities the way we think they should be built. Sorry, that's probably like a 4-minute answer.
No, trust me, you don't need to be sorry. The less I talk, the better on this podcast. You're going to say things of much more value. Um, but no, that's very interesting. I mean, especially the way that you relate it to the '08 crisis, and it was prior even to COVID, and how COVID was kind of the final nail in the coffin.
Yeah.
But it seems like you kind of had that idea coming. Why do you think, just out of my pure curiosity, why did these leases start shortening to such a staggering degree?
Well, I think one of the most important things I saw in Dallas. So Veridesk, the company that builds the sit-to-stand desks and the piece of furniture you can put on top of your desk and it raises up your monitors.
Yes.
So Veridesk started to get into the office business, and they were buying like 400,000 square foot buildings in certain parts of Dallas. And what they were doing was they were building this really awesome amenity center within that building, call it coffee shop, lunch area, collaborative space. And then for the rest of the building, they would outfit it with like hundreds of thousands of square feet of just their furniture and already make it Wi-Fi hot. And so I'm like, there's no way. There's no way that any company is going to take 100,000 square feet of just a bunch of desks. Well, I was wrong. Microsoft and Verizon each took 100,000 square feet, and they signed 3-year leases. And all they had to do was move their people in bodies and move their people out. So they didn't have to build any office space. They didn't have to install any furniture. And a lot of these large companies, Michael, they hire and fire based on quarterly financials.
Yeah.
So when you don't know what your company is going to look like in terms of growth the next quarter, why would you sign a 10-year lease?
No, so that's a fair point.
That was the logic. And I wasn't too worried about it until I saw these very large companies start to do that.
Yeah. No, it's interesting. I mean, the quarterly and the size of the company makes a ton of sense. I never would have thought that such a large part of it was the fact that I mean, now that you say it, it's like, yeah, I hate moving. That definitely would incentivize people to sign a 10-year lease, because it's like, all right, we'll put all of our desks in there and then we don't have to worry about it. But yeah, if all you got to do is move people in there, wow, that is a line of thought I don't think I ever would have thought about. So shout out to you for even thinking about that. That's very interesting.
Well, so check this out. Let's say that you have a 100,000 square foot lease, COVID hits, or your business isn't doing well, and you lay off half your workforce. You're basically now paying for the next 10 years half of the space you're using, which is bad economics.
Oh yeah, that even I can understand that. No, that makes total sense. Yeah. So that left you in the single family realm. And you said one of the big things was it was very status quo. It was what it was. There's not a lot of creativity. Yeah. And given your history and your experience in architecture and, the creativity of building what you want with your Legos, which by the way, I love Legos. Awesome way to start this show. So what have you experienced since then that hopefully has kind of given you what you were looking for?
Sure. So, first of all, it's really enjoyable because we look for homes that need some type of work. we don't want to compete with consumers. That's also bad economics because they will overpay based on an emotional purchase, right?
Yeah.
They're not following a pro forma. So we look for homes that need some type of renovation. And what's been a lot of fun is that with our background, we know what to do to a home that creates the most value, both from an emotional perspective and a functional perspective, from by design, by using good design. And we also know how to control the costs. We know where to find inexpensive tile and inexpensive fixtures that make it feel really elegant and classy and current. And what that has translated into is people like our houses. Our portfolio hovers around 90 to 95% occupied, and our year over year rent growth is pretty consistent. We're getting somewhere, it ranges from 6 to 12% on average year over year rent growth. And we don't determine the rent; the market determines the rent. And so consumers are telling us that they like our homes enough to pay these rents.
So, do you primarily deal with? It sounds like you do primarily deal with renting out these homes. Do you
Correct.
ever do? Are you ever selling them, or is it
No,
purely rental?
purely rental. We will ultimately sell, but we believe that the value creation we're doing is aggregating these homes and then selling them as a portfolio to a high net worth individual or family office or
Okay.
institution as a revenue source.
So it's almost it almost sounds like it is a multifamily way of looking at single family homes. Does that
That's
kind
really well said. I've not used that phrase exactly, but I think that's a great way to look at it. Yeah.
you can buy that phrase from me for a very low price. We can talk about it after the
Offline.
show.
Yeah. Yeah. Let's do that.
You can use it all over your marketing if you want. Like I said, low price, no problem whatsoever. I'm willing to part with it for sure.
Michael, we're going to be longtime friends. Yeah.
I like to hear it. Um, but yeah, no, because that's interesting. Because I feel like typically when I hear and when I talk about single family homes, it's it's the fix and flip, that kind of thing. It's the buying a home, maybe you're renting it, but really your plan, either you're renting it so like it's a beach house or something, and you plan to live in it one day,
Yeah.
or you're really just planning to turn it around so you can sell it. So it's interesting that you are taking like, is it large neighborhoods? Are all of the houses near each other, or like how does that work?
Yeah. Great question. So we like Dallas Fort Worth as a market. And that for everybody that's not familiar with Dallas Fort Worth, it's one of the most resilient markets in the country. Just a few numbers: we've consistently added 120,000 jobs a year for the last 10 or 12 years or something. So it's just we're business friendly. Our economy is diversified. It's not heavily dependent on one industry. And so Dallas Fort Worth is a massive area, and it encompasses now 8 million people. I think we just recently surpassed Houston, I believe. But anyway, uh, so our homes are located all over the metroplex of Dallas Fort Worth. And there are concentrations of neighborhoods that perform really well, and we have several homes, buckets of homes within those concentrations, and then we have some scattered all over the place because we follow profitability. So it's all about what the purchase price is and the price of renovations and what the income would be on that. So they're all over the place. And in fund two, though, we are a part of our fund is we're going to continue to do that, but the other part is going to build brand new communities also from ground up.
Interesting.
Yeah.
And yeah, so I think initially I was thinking about the brand, like the building up from, nothing. And maybe that's just because before I did this, I worked for a pool management company, and a lot of we did all commercial pools, and a lot of what we did were these brand new communities kind of being built up from the bottom, from the bottom.
Mhm.
So that's interesting that's the new fund. That's fun too. So I guess my next question would be, how does someone go about investing in this? How do they join a fund? Like, and what are you telling people to get them to buy into this different way of thinking?
Yeah, great question. So, our fund life for Fund Two is 3 to 5 years. So, and you have to be an accredited investor. And for anyone that doesn't understand what that means, you can look it up. There's a certain income parameters, and so you have to be willing to have your capital tied up for 3 to 5 years, because the real return happens at the sale. It doesn't
Interesting.
happen in terms of real-time current cash flow. There'll be a little bit of that, but it's really about creating that value at the end. So first, your mindset has to be okay with that. But I think what I would say to somebody that's considering investments, I would say first, think about your options, right? So you can sit on cash, which you would be losing right now because of inflation, right? You can buy treasuries and get maybe 5 or a little bit north percentage on the short term treasuries. Uh, or you can invest in our fund, and our fund's downside scenario is like a 7% annual return, and the upside scenario is like almost a 20% annual return. And so I think if you think about your options out there, and the stock market, forget it. It's like, who knows what's going to happen, right?
Yeah, very
Uh,
true.
and so I think that for us, our value proposition is that you have a pretty safe asset class. Not that anything is truly safe, right? But relatively speaking, you're talking about your money goes into the ownership of single family homes.
Yeah.
It's not like a tech startup that if they all drink the wrong Kool-Aid the next day, you're screwed. Um, so it's a relatively safe asset class, and then you have the downside protection of a return, but you have upside potential, unlike a treasury where, yes, it's super safe, but there's no real upside. So if the economy starts booming again, then the value of your treasury starts to go down. Whereas our model contemplates all those different economic scenarios to provide optionality. And I think that there's not a whole lot of options out there like what we're offering that has that
Yeah. I
simple
mean,
setup.
it's absolutely new to me. Granted, not an accredited investor and probably not very much of your target audience, but it's definitely a new realm for me. Um,
Oh, and sorry, Michael, if
yeah,
might add one last thing for Gamma plans, folks, I think it's
beat me
perfect.
to it.
Just because you're not trying to pull out your money early, right? Because there's tax consequences to that. So for self-directed IRA people, this is perfect. Let it sit there for a while, earn that return, and then you're doing what you're supposed to be doing with that type of money.
Ty, you're doing my job for me. I mean, you literally you stole the words out of my mouth. It,
Hey,
it, it
you
is
took mine
perfect.
earlier. This is perfect. Yeah.
It is because in other types of funds, when you're investing your own money, having that money sit there and not do anything for a little bit, even if the payout is good at after 5 years. Not to say it's a bad plan, but it's definitely I can see why someone might get turned off by that. Whereas when you're using your retirement money,
Right.
that's almost it's almost ideal because it's just you can wait until the end to get that large sum of money, and
Sure.
you're willing to wait because retirement as a whole, I mean, depending on your age obviously, but it's something that is built to be a 30 a 40-year investment, whatever it is. So if after 5 years your return is that much better than if you were getting something month by month or year by year, that it does seem like it was made for self-directed IRAs, 401ks, all that kind of stuff.
Yeah, and well said. And just FYI to the audience, those returns were net of fees. And so, wanted to make sure I stated that. And I would encourage people to do their own homework, right?
Always.
Like I don't think single families a great bet in every city. So I think people need to like. I love Dallas as a submarket. I like San Antonio. I like Atlanta, Chattanooga, maybe even Nashville, maybe. But you want to pick markets that aren't cyclically volatile. Like Phoenix was booming, but now Phoenix is struggling. Austin was booming, now Austin is struggling. And so you don't want to do that because you don't want to try to time anything, right? That's like fashion. And I would encourage people to diversify. So put a chunk with us, put a chunk in treasuries, leave a chunk in cash, yeah.
I do want to be very clear. Quick disclaimer. When Ty says that he loves Dallas, I want to be clear. He does not speak for both of us. Go Birds, go Eagles. And honestly, I kind of hate Dallas. So more as a football team than a city. But I wanted to be clear about that. I don't want anyone putting words in my mouth. So,
well, you just teed me up for something else. Point taken on your Dallas opinion. I will say that it's ugly, meaning there's no mountains, there's no water. It's hot.
Very hot.
But we are centrally located, business friendly, and you can still. This is going to blow some of your audience's mind, depending on where they live. Right now, you can still get a 3-bedroom, 2-bath home somewhere in the Dallas-Fort Worth Metroplex, 2,000 square feet, 5 out of 10 minimum ranking for elementary, middle, and high for $350,000.
Wow.
And so try to do that in California or New York or Chicago, or.
So maybe Dallas isn't bad at everything.
Not at everything. I just would make sure you have some kind of a couple of week escape in the summer.
Yeah.
Somewhere
maybe to a team that can make a Super Bowl in the last century, but
No, but we're really good at marketing though, Michael.
You're very correct on that. 100% can't argue with that. America's team, absolutely. All right, enough about my football biases.
Okay.
Only because I'll go all day if you let me.
We can do that a different day. Yeah.
Yes, that's fine with me. So in this transition, obviously, I'm assuming that you learned a lot going from what you were doing to this, a new way of looking at single family homes and those types of funds and investing. And I'm a big proponent of learning more when you fail than you do when you succeed. Sure. And I'm curious if along the way you've had any, don't have to be significant, but any failures, any mistakes that you experienced or that you saw that you were able to learn something from that you could speak about.
Sure. Yeah. That's a great point. So I think it's good. And I think it's a lot of times it's good that your perspective, I think if you've always been in one space, I think sometimes it's not as easy to have a new perspective on it. And what I really liked about single family is that there was no middle market operator. There were these large institutions that, I can say good and bad things about. And there are mom and pops that I can say good and bad things about from an operation standpoint, not them personally. But there was nobody in the middle.
Yeah.
And what I liked about our background is that we have institutional experience, but we're nimble in that we don't have all the red tape. Yeah. And what that has allowed us to do is to quickly innovate. For example, I hate that in the beginning of the company, I hated that we were doing the traditional sending an inventory and condition form via email and PDF. The tenant would print it out, walk around the house, mark down all the stuff they saw, scan it, send it back. And I'm like, this is 2023. Back then it was 2021. And I'm like, there's got to be a different way to do this. Yeah. I'm like, there's got to be a different way to do this. And so we found an app that allows the tenants to walk around the home with their phone, take pictures, and it walks them through what to take pictures of. They can tag the pictures with a text, and they just upload it to the cloud, and it's done. And tenants seem to love it, and we love it because it's universally accessible and very convenient. And so, I think to answer your question, I think that our handicap kind of became our advantage in that we just approached it in a non-traditional way. I think there's other things like it took us a few months to find really great value vendors, the ones that do just as good of a job as the big boys, but cost half the cost.
Yeah.
So it took us a few months to find those guys, but we've got them now, and they're awesome. And frankly, Michael, the last thing I'll say is that what we're seeing is we're actually seeing multifamily developers start to copy some of the single family scattered strategies. For example, do you really need people on site all the time at every complex? Or can some of these things be shared, or third partied, so you don't have all the carrying costs? And so we're starting to see some of that too.
That's interesting. And I think you make a really good point that your handicap can become your advantage in a lot of ways. And, obviously it doesn't always work out. I'm sure there were times where your handicap was just your handicap, and that's the reality of it. But in things like that app, like when it doesn't take that long for you to implement something with larger companies, I would assume larger operations, making those types of sweeping changes are something that will take longer. It becomes a headache for so many different reasons. But if you're able to just kind of snap your fingers and make that change, no one's going to complain about something being easier for all parties. Well,
that's right.
99% of people won't complain about something being easier for all parties.
Yeah, that's right. Yeah. I mean, you're always going to have certain tenants that are just non-responsive because that's just their personality.
Yep.
But thankfully they're the minority.
Absolutely. Yes. The vocal minority, but the minority.
Probably. Yeah.
So last thing, before I ask you to plug yourself and let the listeners know where they can find you, something I like to ask every guest that comes on here is simply, what does financial freedom mean to you?
Great question. To me, it's actually about time. And let me explain. So no matter who you are, whether you're Bill Gates or the hobo down the street, you have the same amount of time on this planet. And so, to me, financial freedom means learning how, if this is your personality and this is what you want to do, learning how to create a passive income structure to where the lifestyle that you want is covered through this passive income, thereby creating time for you to do whatever it is you want to do with your time. Because that is the most precious thing, I think, as a commodity that everyone has.
That was well said.
Thanks.
Short, sweet, and simple. And honestly, I don't think I could say it any better.
You can take that too, Michael.
Okay. We can trade them. We can trade. I'm losing out on some money here, I feel like. But, I'll make the trade 1-for-1.
Okay. Cool.
But on that note, could you please tell the listeners where they can find you, how to reach out to you if they have questions?
Sure. Yeah. So I think Michael mentioned that my contact info will be displayed in our website.
Yep.
But please reach out to me directly, or you can go on our website and do a general inquiry. Our office number's on there. But you can find out about us, our portfolio, our team. There's a link that'll take you to learning more about Fund 2. And we would love to help out in any way we can in your platform.
Yeah, and as always, all of those links and all of that information will be down in the description below for you guys to click on and follow. So Ty, thank you so much for hopping on here. I feel like I learned a lot today. It was really enjoyable talking to you just about, the different way that you guys are able to kind of explore this, pretty popular community, a popular area of the market.
Sure. Yeah. Well, Michael, thank you for having us on today. Really enjoyed it. Great to spend time with you, and look forward to staying in touch.
Absolutely. And as always, thank you for listening to The Road to Financial Freedom. If you enjoyed the show, please support the podcast by remembering to rate, review, and subscribe. You can keep up to date with us on Facebook or Instagram at Road to Financial Freedom Podcast. Thanks again, and I'll see you next time. If you like what you're hearing on The Road to Financial Freedom and want to learn more about self-directed IRAs and 401ks, click the link in the description to download a free toolkit with everything you need to get started.